Hello everyone, a very good evening. So, how are you all? I hope the audio and video is fine. And today in this session, we are going to discuss all the important MCQs covering all the chapters from our Module B. Module B, which is very important for our exam. We have the important acts like the Prevention of Money Laundering, FEMA, Negotiable Instruments Act, Payment and Settlement Systems Act. We have already completed the theoretical part in our capsule batches. Today we'll be discussing the questions. So, I want all of you to please participate, try to answer all of these questions, be active. Even if you get them wrong, don't worry, you'll get the answers right here. Okay, so I think we are good to go and we can start. Yes, okay. So let us begin with the first question for our marathon for module B. So here's the question. Under section 13, subsection 2 of the PMLA, as amended by the 2012 Act, which of the following actions can the director legally take against the reporting entity for the non-compliance with obligations under Chapter 4? Chapter 4 talks about the obligations of the banking companies, the reporting entities. So the reporting entities have to report to the director certain transactions, right? Cash transactions above 10 lakh of rupees, all the cross-wire transaction, cross-border wire transactions, acquisition of property above 50 lakh rupees, all of these things that we have studied. If they contravene, so what action can the director take? They can suspend its license and initiate criminal prosecution automatically, issue a warning in writing, and or impose a fine between 10,000 to 1 lakh for each failure, confiscate the entity's property without prior notice, recommend removal of the designated director from the board permanently. So what should be the correct answer? Comment down your answers. Right. So if the director, in the course of any inquiry, finds that the reporting entity or its designated director on the board or any of its employees has failed to comply with the obligations under the Chapter 4, what they can do, they can issue a warning in writing, they can direct the reporting entity to comply with the specific instructions, they can direct the reporting entity to give reports on such intervals, also levy a fine which shall not be less than 10,000 rupees but may extend to 1 lakh rupees for each failure. So each of the failure will be considered as a different separate offense and even a continuing offense. So the correct answer will be B. All right. So this was with the amendment of the Prevention of Money Laundering Act. That the section 13, it was amended. And powers were given to the director to impose fine. Right? Issue a warning, direct to comply, give reports, or even levy a fine. All right? So the correct answer will be B. Okay, let's move on to the next question. Which of the following correctly defines the punishment under Section 4 of the PMLA for offences relating to crimes under the paragraph 2 of Part A of the schedule? So, what is the punishment under the PMLA? Minimum 3 years and maximum 10 years, rigorous imprisonment with fine, minimum 5 years, no prescribed upper limit, 3 years, maximum 7, without fine, or fixed term of 10 years rigorous imprisonment. What is the offense of money laundering? If any person is involved or they are knowingly helping another person to conceal a property, possession, acquisition, use, projecting it as the untainted property, and if it is a continuing activity. So, what is the punishment? Earlier, the punishment according to section 4 was that a rigorous imprisonment for a term not less than 3 years but may be extended to 7 years. But then in the schedule, and now this 7 years has been changed to which may extend to 10 years. So this has been substituted. That is why the correct answer will be A. Minimum 3 years and maximum 10 years rigorous imprisonment with fine. Yes, correct answer is A. Great. Right. Now, when we are talking about the fine, fine depends on the activity, on the offense that has been committed. All right. Okay. Then let's see the next question. Rule 3 requires the reporting entities to maintain the records of which of the following high value transactions involving instruments other than cash. Other than cash. Purchase of immovable property registered and valued at 60 lakh rupees. Cross border wire transactions to India of worth rupees 6,000. Subscription of 15 lakh in non convertible debentures. 5 lakh rupees transferred from a security account linked to an NBFC. So these are the rules, the records to be maintained other than cash transaction. You need to answer other than cash transactions. So what will be the correct answer? If it was a cash transaction, then the value is what? 10 lakh rupees. But the question is asking us about other than cash transaction. So which of the following should be reported? Let us go through the statements one by one. When we are talking about the immovable property, then the threshold limit is 50 lakh rupees or more. The statement one says the immovable property is 60 lakhs. So yes, it will be reported. Second, cross-border wire transfer to India. Cross-border wire transfer of more than 5 lakh rupees or its equivalent. It's equivalent in the foreign currency. So when we are talking about euros, its equivalent is 6,000. So this will also be included. And non-convertible debentures, if we are talking about, then 15 lakhs. So this is also correct. But fourth transfer, 5 lakh transferred from a security account linked to an NBFC. This is not true. All right. So the correct answer will not be D. It will be 1, 2, and 3. That is A. All right. So let us recall all the records that have to be maintained regarding the cash transaction value more than 10 lakh rupees. All the receipts by the non-profit organizations again more than 10 lakh rupees. Cash transactions where the forged or counterfeit currency notes are there. Any suspicious transaction, doesn't matter what is the value. If it is a suspicious transaction, deposits, credits into any non-monetary account, demat account, payment orders, cashier's check, anything, or even a loan. Then collection services in any currency, cross-border wire transaction more than 5 lakh rupees or its equivalent in the Indian currency, and all the purchase and sale of immovable property valued at 50 lakh rupees or more. So these are the records that have to be maintained. So the correct answer will be A, 1, 2, and 3. All right. Okay. Now answer this question. A financial intermediary receives 4 lakh cash deposits. Okay. They're receiving 4 lakh cash deposits 3 times. over 25 days from a single client, each 9 days apart into different batches, but linked by mobile number. What is the compliance implication under the rule 3B? Again, the records that have to be maintained. Only the last transaction needs record maintenance. No record is required unless the cash deposits exceed 10 lakh individually. All three must be collectively treated as integrally connected and recorded. Reporting is required only if the deposits are in foreign currency. So, what will be the correct answer here? Three transactions, three cash deposits worth rupees 4 lakh each. So, total is becoming 12 lakhs over 25 days, 9 days apart, integrally linked by the mobile number. Yes, they will be collectively treated as integrally connected. Why? Because this says all the series of cash transactions which are integrally connected to each other that have been individually valued below 10 lakh, but this series of transactions takes place within a month and the aggregate exceeds 10 lakh rupees. Right? So this will be maintained. The transaction has to be maintained. Okay, so the correct answer will be C. I hope this is clear. Yes. Okay. Next, under Rule 3BA and 3D, which type of transactions must be recorded irrespective of whether made in cash or not? Receipt by the non-profit organization exceeding 10 lakh rupees, transactions with third-party checks, even if not suspicious, all suspicious transactions regardless of the mode of payment, debit entries from the demat accounts without linked cash flow. So which of these following transactions have to be recorded? And specifically you need to answer according to the rule 3BA and 3D. So 1, 2 and 3, 2, 3 and 4, 1 and 3 only, or all of the above should be recorded in this scenario. What will be the correct answer? D, all of the above. Alright, so one has to be recorded. Receipt by a non-profit organization exceeding 10 lakh rupees, correct. Transactions with the third party checks. Third party checks, if they are of the suspicious nature, then they will be recorded. Otherwise, there's no reason to do so. All right, so this is incorrect. All the suspicious transactions, regardless, yes. Doesn't matter what is the mode of payment. If it is by deposit, credit, through checks, third party, pay order, demand draft, traveler's check, transfer from one account, whatever mode. If it is suspicious, it will have to be recorded. And debit entries from the demat accounts. Now, debit entries from the demat account, if it is related to the cash transaction, then it will have to be recorded. Otherwise, not. All right. So the correct answer here will be 1 and 3 only. So the correct answer will be C, 1 and 3 only. Okay. All of these rules under the rule 3, A, B, C till F, everything I've included in the PDF. You can download the PDF after the class and you can go through the notes. All right. Okay. Next question. Now consider the rules 6 and 8. Which of the following practices must the reporting entity adhere to for valid compliance? Maintain both hard and soft copies of the reportable transactions. Submit the property sale reports every month. Follow RBI or SEBI specified procedures for record maintenance. Ensure the transaction record includes currency denomination. So now this question is regarding the procedure for the maintenance of records. So which of the following statements are correct? What information has to be maintained in the record? The nature of the transaction, cash transaction, or it is a electronic transaction, whether it is in a Indian currency or any foreign currency, the amount of the transaction and the currency, the date on which the transaction was conducted, as well as the parties to the transaction. This information will be maintained. Other than this, what else should be followed? So, maintaining both hard and soft copies of the reportable transaction, yes, this will be as specified by RBI or SEBI. RBI or SEBI is going to specify in which manner the record has to be maintained. Following the RBI and SEBI specified procedure, and ensure that the transactions includes the currency denomination. So value, nature, name of the party, everything should be recorded. However, submit the property sales report every month. This is not true. The rule 3F says about the purchase of immovable property valued at 50 lakh rupees or more. But as per the rule 8, if we talk about the rules for cash transaction, individual cash transactions, or the non-profit organization, all of these, then the information has to be provided to the director by the 15th of the next month, right? If we are talking about those transactions that are of suspicious nature, then not later than 7 working days from which the transaction occurs. And if we are talking about the rule F, then the information is not to be given monthly, but 15th day of the month succeeding the quarter. So quarterly reports for the property has to be given. All right. Again, all the rules, how the information is to be provided to the director, right? Suspicious nature, not later than 7 days. And if we are talking about the rule F, immovable property, then every quarter by the 15th day of the month succeeding the quarter. So the correct answer will be D. 1, 3, and 4. All right. Yes. So 1, 3, and 4 will be correct. Second statement is incorrect. All right, next. As per the rule 4, the primary objective behind mandating the specific fields of information. The rule 4 talks about what all information has to be included in the records. Why this information is to be recorded? To enable tracking of the customer demographics for the marketing purpose, permit swift recovery of the unpaid taxes by the tax authorities, allow complete reconstruction of the individual transactions when required, facilitate automatic reporting of non-compliant entities. I think this question is very simple. You can easily answer this. Yes. What will be the correct answer here? According to the rule 4, why do we maintain these records? And what all information we already discussed: the nature of the transaction, amount of the transaction and the currency, the date on which the transaction occurred, and the parties. So these information has to be recorded so that we can completely reconstruct the individual transactions as and when required. Yes, C is the correct answer. And it will be maintained for 5 years from the close of business with the client. All right. So for 5 years, the records have to be maintained. This will also include the identity verification of the client. So due diligence. Due diligence. Okay, next question. Which of the following are true in relation to the interim compensation under section 143A? So now we are talking about the Negotiable Instruments Act. There are two important sections, 143A and 148, that have been included by the amendment made in 2018. It talks about the interim compensation. So what is true about 143A? The compensation must be paid within 90 days from framing of the charge. It can be recovered as a fine under section 421 of the CRPC. If the drawer is acquitted, complainant must refund with interest at RBI's notified bank rate. It applies retrospectively to all the pending cases. So what is true about the interim? Also, tell me in the comment section what is the percentage of this interim compensation that is required to be paid. So the Negotiable Instrument Act says whenever, let's say we are taking the check, a check is dishonored, right? When a check is dishonored and the bank is taking it to the court will accept the dishonor of the check until and unless it is proved otherwise. Now, if let's say the defendant, who was the drawer of the check, they're coming to the court and saying that no, this has been wrongfully dishonored, I had enough funds in my account, they will be heard, their appeal will be heard, but first they will have to pay an interim compensation. That interim compensation will be 20% of the amount of the check or the total compensation that is awarded by the trial court. That is the section 148. So 143A says 20% of the check amount will be paid to the complainant where the drawer pleads not guilty. This 20% has to be paid within 60 days, or it can be extended to 30 days if the court has enough reasons to believe that that delay is possible. And yes, it will be recovered as a fine under section 421 of the CRPC. So the correct answer will be C. 1, 2, and 4. 1, 2, and 4. All right. No, actually, it should be 1, 2, and 3, right? It doesn't apply retrospectively, it applies prospectively. It applies prospectively. Third statement is correct. If the drawer is acquitted means if the drawer is found not guilty, then the compensation amount, this 20%, will be paid back to the drawer along with interest at the existing bank rate as given by RBI. Okay, so the correct answer will not be C, it will be A. 1, 2, and 3. 1, 2, and 3. All right. Hmm. So if the drawer of the check is acquitted, the court shall direct the complainant to repay to the drawer the amount of the interim compensation with the interest at the bank rate as published by RBI. Again, within 60 days. All right, so the correct answer will be A. Okay. Which of the following best describes the jurisprudential character of section 143A in the check dishonor cases? It introduces punitive damages for the check dishonor. It ensures early monetary relief through the quasi-penal interim compensation. It reverses the burden of proof from complainant to the accused. It converts all check dishonor matters into civil suits. So, how do we describe the section 143A? Come on, answer this question. What will be the correct answer? So as we discussed, the section 143A talks about the interim compensation. So it ensures early monetary relief through the interim compensation of 20%, so that the complainant, that is the banker, they can continue with their business. Yes, correct answer will be B. All right, so if the drawer pleads not guilty, they will have to pay the interim compensation 20% of the check amount within 60 days to the complainant. Now, here's a case study for you. A complaint is filed under Section 138 of the Negotiable Instrument Act for the check dishonor. The accused pleads not guilty at the first hearing. The court, upon application by the complainant, directs payment of interim compensation. The accused fails to pay within the first 60 days but requests an extension due to hospitalization. Eventually, he is acquitted on merits. What is the maximum quantum of the interim compensation that the court can order? So, as you can see in this case study, a whole scenario, a whole story is given to you, but basically the question is asking you the maximum quantum of interim compensation. So again, I have been telling you so many times, if you have the conceptual clarity, you can easily answer the case study questions. All right, so simply you need to mark the option which tells the correct interim compensation. So what is the correct answer? 20% of the check amount, 50% full check amount, fixed amount of 1 lakh, or the check amount, whichever is lower. So what will be the correct answer? Yes, so the correct answer is A, 20% of the check amount. And if you do not have the conceptual clarity, if you do not know exactly what is this interim compensation, then you won't be able to answer it. Doesn't matter how many case studies you have practiced. All right, so 20% of the check amount is the maximum quantum of the interim compensation. All right, next question. As per the newly inserted Section 148 of the Negotiable Instruments Act, what is the minimum quantum of deposit the appellate court may require from the appellant during the pendency of an appeal? So 143A, when the drawer pleads not guilty in front of the court, 20% of the check amount is the interim compensation. Let's say even after the interim compensation is paid, after hearing both the parties, the court gives an award in favor of the complainant. All right. But the drawer still says that I'm not satisfied with this decision taken by the trial court. The drawer will take this case, they will file a further appeal to the appellate authority. But now the appellate authority also requires the drawer to pay certain amount. So what is the amount now? 10% of the check amount, 50% of the check amount, or any interim compensation paid, full amount of the check dishonored and interest at the bank rate, or 20% of the total fine or the compensation awarded. So now we are not talking about the section 143A, we are talking about the section 148. Answer accordingly. What will be the correct answer? So here as well, the appellate court may order the appellant to deposit an amount will be that will be minimum 20%. In the case of the section 143A, the compensation was not exceeding, so maximum 20%. But in this case, the section 148 says minimum 20% of the fine or the total compensation that is awarded by the trial court. So 20% of the total fine or the compensation that has been awarded. And this 20% will be in addition to the compensation, to the interim compensation that was paid under section 143A. It will be in addition to the interim compensation. Again, it has to be deposited within 60 days or 30 days more. And if the drawer is acquitted, it will be returned to the drawer along with the interest rate as prescribed by RBI. Alright, so please remember, interim compensation is maximum 20% of the check amount, section 143A, and the appellate authority directs the drawer to pay under 148 minimum 20% of the fine or the total compensation that is awarded. Do not get confused here. Alright. Which of the following situations would trigger the shift in the burden of proof regarding the holder in due course, which is a presumption under section 118? When the instrument is shown to be obtained by fraud, when consideration is shown to be inadequate, when the instrument was acquired from an unauthorized custodian, when the endorsement lacks date and signature clarity. So, which of these following events would trigger the shift in the burden of proof? Again, if you remember, we have the holder, holder in due course, and holder for value, the terms which are used for the protection to the collecting bank, right? So, the holder in due course means any person who for consideration becomes the possessor of the negotiable instrument, like it has been endorsed to them or payable to bearer before the amount mentioned actually becomes payable, right? And there's no cause to believe that any defect has existed in this instrument. That is a holder in due course. So here the proof of possession will shift when the instrument is shown to be obtained by fraud or where the endorsement lacks date and the signature clarity. All right, where it is clearly visible that yes, it has been obtained by fraud or it does not match the endorsement. So this will be the correct answer. All right, D, 1 and 3. Okay. So holder in due course, holder of the negotiable instrument, where the instrument has been obtained from the lawful owner or from a person in lawful custody, means of an offense or fraud, then the burden of proving that the holder in due course lies upon the holder itself. So, no, 1 and 3. Sorry, 1 and 3. Not 1 and 4, but 1 and 3. All right, 1 and 3. Because it is acquired from an unauthorized custodian or obtained by a fraud. Then this last statement, which talks about the holder in due course. This one. If let's say it has been acquired by an offense or fraud, then or by an unlawful consideration, then the burden of proving that the holder in due course lies upon him. Otherwise, the collecting banker will be given protection because they have no reason to believe that the negotiable instrument has been acquired by fraud. It is made for consideration, it is accepted as per the reasonable time, and every transfer was made before the maturity. If all of these things are there, then the collecting banker will be given protection. All right. If a bank wrongfully dishonors a check due to an internal error, but the drawer had sufficient funds, who can claim compensation under section 31. So in the case of a wrongful dishonor, the bank has to pay the compensation. But who can claim for the compensation? The drawer only, the payee only, the holder in due course, both the drawer and the payee equally. So what happens in the case a wrongful dishonor is there? Um, no. Actually, in the case of the wrongful dishonor, the drawee is only liable to the drawer for the compensation, not to the pay, any holder or any endorsee. All right, so the drawee, who is the bank in this case, will be only liable to the drawer, not the payee, not the holder, not the endorsee. All right. The bank will not have to pay any compensation to the person to whom the check was to be paid, or any holder or any person to whom the check has been endorsed. Only to the drawer of the check, this compensation that was there at the bank rate prescribed by RBI, it will be paid. Except in certain conditions, except let's say the bank is winding up or the bank does not heed to the crossing of the check, pays, and consequently in case of misrepresentation, then he will become liable to the true holder or the pay. All right, so the bank will be liable only to the drawer for the loss or the damage, not to the pay or holder or endorsee. Okay, this is also a very important point. So the correct answer is A. Clear? Yes. What is the exception? If the bank is being wound up, it is closing down, then they will become a creditor, and they would also, the holder would be entitled to claim a compensation. Or if the bank, the check was crossed, they did not pay heed to the crossing and still they pay. And the true holder or the payee, now they can also come and claim the compensation. So only in these two cases. Otherwise, the bank will be liable only to the drawer. Okay. A bank may validly refuse to honor a check even if funds are technically available under which of the following conditions. So the funds are available in the drawer's account, still the bank is refusing to honor a check. Why? The check is not signed per the mandate. The drawer's funds are under judicial attachment. The check has incorrect date but is otherwise valid. The funds are earmarked due to an internal lien. So, what will be the correct answer here? When can the bank reject to honor the check? Yes. A, B, and D. Correct. Right? So, there is no overdraft facility, proper application has been made that the payment is to be made to the customer. The fund should not be earmarked for any other purpose. All right. So, the correct answer will be D. Okay. So, when can the bank reject to honor the check? When the check is not signed, when the drawer's funds are under judicial attachment, if the drawer is going into insolvency or they have been uh, convicted of a criminal offense, let's say money laundering, and their funds have been attached by the court, or the funds are earmarked due to an internal lien. Bank is exercising his powers of lien over the funds, as we have studied yesterday. All right, so A, B, and D will be correct. All right. Which of the following are prerequisites for a banker to avail the protection under Section 85 of the Negotiable Instruments Act? Payment must be made in due course. The check must be crossed generally or specially. The check must be either payable to order or bearer. The banker must verify the signatures of all the prior endorsees. So the Section 85 gives additional protection to the paying banker against fraudulent endorsements, right? But it will be provided only if the payment is made in due course. So in which cases the bank makes the payment and later on it is found that it was fraudulently endorsed or some material alterations were made but they were not visible to the naked eye. So in which of these following cases protection will be provided? First, payment must be made in due course. So one is correct. If the check is crossed generally or specially, still the bank is making the payment, protection will not be provided. If the check is mentioned payable to order or bearer, okay, it is also true. But it is not the responsibility of the banker to verify the signatures of all the prior endorsees. How can a bank know how many people have been endorsed this check? Right? It is not possible for the bank to know. So, if 1 and 3 is followed, then the bank will be provided this additional protection under Section 85. All right. So, when a check payable to order purports to be endorsed by or on behalf of the pay, the drawee is discharged by the payment in due course. That is, it means that the drawee has made the payment in due course. When a check is originally expressed to be payable to the bearer, then also the drawee is discharged. Doesn't matter whether in full any endorsement has been made or not. All right, so this act seeks to protect a paying banker from the fraudulent endorsements of the payee as well as the subsequent endorsees because the paying banker cannot be expected to know the signatures of the payee and the various endorsees who are not the customers of the bank. All right. So it is not the responsibility of the bank to verify all the signatures. Okay. Choose the incorrect statement about the instances of a material alteration. You need to choose the incorrect statement. Alteration in the date of the instrument can hasten or delay the time of payment. Alteration of the amount is the most common form of fraudulent alteration. Alteration of the name of the payee does not count as the material alteration. Alteration of an order check to a bearer check is a form of material alteration. So, protection is provided to the banks if there has been a material alteration, but it is not apparent. That means when the payment is made by the bank on the presentation of the instrument, which is forged, which has been fraudulently, some changes have been made, but they are not apparent, they are not visible to the naked eye. Protection is provided. What is a material alteration? Which alters the instruments, the liabilities of the parties to it. Doesn't matter whether it is beneficial or prejudicial to the pay. So it changes the legal character of the instrument. A materially altered check may be declared null and void. So alteration in the date of the instrument, alteration in the name of the pay, alteration of the amount, which is the most common form, as well as the alteration of a order check to a bearer check is a form of material alteration. So the statement C, which says that change of the name of the pay does not count as material alteration, this statement will be incorrect. All right. So there was a very famous case here. What happened? The bank, they paid the check, honored the check after receiving it from the person, and later on it was claimed that it has been forged. But this claim was, or the exactness of the check was visible only under the ultraviolet lamp. So the court here took decision in the favor of the bank. It said that clearly the material alteration should be visible to the eye, but it was not visible, so the bank could not be held guilty just because the check was not examined under the ultraviolet lamp. All right, so if after considering, after making all the due diligence, checking the necessary information, then the bank makes the payment, later on it is found that it is forged, but it was not apparent, bank will be given protection. All right, so these are the instances of material alteration. Okay, another case study. Rajesh, a businessman who found was found to have contravened the FEMA regulations by engaging in unauthorized foreign exchange transactions amounting to rupees 10 crores. Upon adjudication, it was determined that he had violated the provisions under Section 13. Under the Section 13, what is the maximum penalty Rajesh could face for contravening the act? Assuming that the sum involved is quantifiable. Again, doesn't matter what was the offense, doesn't matter what was the amount of the transaction. The question is simply asking you what is the penalty under the FEMA Act if the sum amount is quantifiable. So there are two cases where we can quantify it and where we cannot. So where it is quantifiable, where it is not quantifiable. So here the sum involved is quantifiable. What will be the penalty? Twice the sum involved, five times the sum involved, a fixed penalty of 2 lakhs, or thrice the sum involved. Answer this question. I'm waiting for your answers. Yes, what will be the correct answer? Okay. So if the amount is quantifiable, then thrice the sum involved will be the penalty to be paid. So the correct answer becomes D. So here 10 crores, so the penalty will be 30 crores. All right. So thrice the sum involved. If it is not quantifiable, if the amount is not quantifiable, then up to 2 lakh rupees where we cannot quantify, where we cannot identify. No, not A, not twice, thrice the amount, right? So upon adjudication, he will be liable to a penalty up to thrice the amount involved, where the amount is quantifiable, or up to 2 lakh rupees, where the amount is not quantifiable. And what if the contravention is a continuing offense? It continues for more than 1 days. Then what will happen? The further penalty, which may extend to rupees 5,000 for each day that the offense continues. All right, 5,000 rupees for every day after the first day during which the contravention continues. So remember these 3 points. Thrice the amount if it is quantifiable, up to 2 lakh rupees if it is not quantifiable, and if it is a continuing one, exists for more than 1 days, then 5,000 rupees for each day when the contravention continues. All those who are here, please try to be active. I want all of you to answer the questions. I'm seeing only one person giving the answers. Please answer. Also, like the video and share it if others have not yet joined, any of your friends, any of the other aspirants. If they want, they can join. All right. Okay. Which of the following will constitute a material alteration and could render the instrument void if made without the drawer's consent? If the payee makes any alteration without the consent of the drawer, which of the following situations, circumstances will constitute a material alteration? Changing the check amount from 10,000 rupees to 1 lakh, changing the check date to 2 days earlier for faster encashment, cross check converted into the bearer by striking the crossing, overwriting the MICR code without changing the transaction content. Which of the following will be considered as a material alteration? So, statement 1 is correct. If we change the amount, it will be a material alteration. If we change the date, which has the effect of delaying or making the payment faster, cross check is converted into a bearer check. So, change of the order check into a bearer check. And the fourth statement, so this will be also correct, but overwriting the MICR code without changing the transaction content. The transaction content is not changed. This is not a material alteration. So 1, 2 and 3. All right, 1, 2 and 3. Now, the material alteration information was already included in the previous questions. Here I have included the section 89. All right, where the check or the other negotiable instrument has been materially altered, but it is not apparent, or where the check is presented for payment and it does not appear to be crossed, then the banker who makes the payment in the due course according to the apparent tenor will be discharged from their liability. Or if the check is an electronic image of the truncated check, if any difference is apparent there in the tenor of the electronic image, that is the electronic image and the check, they are different in the material information, then also the bank makes the payment. Then the bank will not get the protection. So the exactness of the apparent tenor of the electronic image of the truncated check should be ensured. It should be exactly the same. All right. Okay, so 1, 2, and 3 is the correct answer here. Now, which statements correctly reflect the concept of holder for value in the banking context? A bank that credits a check amount before actual collection assumes this position. A holder for value enjoys the same statutory protections as a holder in due course. The bank may act as a holder for value even without informing the drawer. A holder for value can retain proceeds even if the check is later dishonored due to fraud. So, holder for value. Which of the following will be the position of a holder for value? When a bank who is to oblige a customer for any reason, they pay the amount of the check that is drawn on another bank before its collection, the position of the bank that is obliging the customer is that of a holder for value. All right. The rights of the holder for value, if let's say without knowing that the check had been stopped or endorsed, the bank has endorsed, it has been endorsed or anything, the bank manager, they pay the check. What will happen here? The bank will be considered as a holder for value. They will not be considered liable, they will not be considered guilty. So first statement, a bank that credits a check amount before the actual collection, this is true. A holder for the value enjoys the same statutory protections as a holder in due course, this is also true. The bank may act as a holder of the value even without informing the drawer, this will also be true. and the holder for value can retain the proceedings even if the check is later on dishonored due to fraud. This was the point that we discussed, right? So the correct answer will be D. Yes, all the statements are correct for the holder for value. So when a bank, to oblige the customer, pays the amount of the check drawn on another bank before its collection, first statement, the rights of the holder for value is demonstrated in the English law, where the drawer of the check stopped its payment through a notice given to the branch on which it was drawn. But this information did not reach the paying bank here. So without informing the drawer, they can make the payment. This is also true. The payee, however, without knowing that the check had been stopped, endorsed the check, and the branch manager in good faith advanced money. They had no knowledge that the check had been stopped. So it was held that the bank was the holder for value of the check and was entitled to relief. So same statutory protections, and the holder for value can retain the proceeds even if the check is later dishonored due to fraud. No, the correct answer will be D. All these statements are correct. Clear? Why D is correct? Okay. What constitutes an offense under Section 138 of the Negotiable Instruments Act when a check is returned unpaid? The check is returned due to insufficient funds in the account. The check is presented after 6 months from the date it was drawn. The check is returned due to the drawer's instructions. The check is presented within 3 months from the date it was drawn. So you need to tell me what constitutes as an offense. Out of these situations, only one is considered as an offense and others are not. So which of the following is an offense under the Negotiable Instruments Act? The check is dishonored due to insufficient funds in the account. This means that the check is returned either because of the amount of money standing to the credit is insufficient to honor the check, or it exceeds the amount arranged to be paid from that account by an arrangement made with that bank. All right. And what is the punishment? Imprisonment for a term that can be extended to 2 years, or a fine that can be extended to twice the amount of the check, or with both. No, when the check is returned due to the drawer's instructions, this is not an offense, right? In other three situations also, the check is returned, but this is returned in the normal course. If after the maturity the check is presented, it is returned, or the check is returned because the drawer has stopped the payment, the drawer has given the instruction to stop the payment, or the check is presented within 3 months from the date it was drawn, these situations are not offense. All right, offense is when it is returned due to insufficient funds in the account of the drawer. All right, okay. Hmm. Now answer this case study. XYZ Private Limited, a fintech company, has developed an innovative payment gateway enabling instant cross-border transactions. Eager to launch its operations, the company begins facilitating transactions among its users. However, upon scrutiny, RBI notices that the XYZ Private Limited is operating without its authorization. The company, however, argues that it qualifies for an exemption under one of the Act's provisions. The RBI must decide whether this company can continue or if it must cease until authorization is granted. So, which of the following exemptions would not apply to XYZ Limited? Certain companies are exempted from for the provision that they need to get authorization from RBI, only then they can commence the payment and settlement. So the company is operating as an agent for another entity to whom the payment is due. The company is accepting payments from its holding company or fellow subsidiaries. The company has obtained explicit exemption from RBI. The company has developed innovative technology for payment processing. So we know that no other entity other than RBI itself can operate a payment system without authorization from RBI. But there are certain exemptions. Which of the following is not an exemption? You need to answer which of the following is not an exemption. So, just because the company has developed an innovative technology for payment processing, they will not be exempted from getting the authorization. All right. So, if the company was operating as an agent or they're just accepting payments from its holding company or RBI has specifically exempted the company from obtaining the authorization. These are the exemptions. But just developing an innovative technology will not exempt them from the provision of getting the authorization. All right. Identify the true statements about a current account transaction. So if you remember, we differentiated between the capital account and the current account transaction. So which of the following statements are true? The current account transactions include payments due as interest on loans. It involves changes in the asset or liability outside India. It includes remittances for living expenses of the family members residing abroad. It includes the expenses in connection with foreign travel, education, and medical care of the family. Which of the following transactions would constitute a current account transaction? Yes, A, C, and D. B is correct. All right. The second option is correct. A, C, and D. If the asset or liability outside India change, this will become a capital account transaction. But the asset or liability do not change, that is a current account transaction. All right, so the capital account, either an increase or decrease, current account other than a capital account, where there's no increase or decrease in the asset or liability holding. All right, select the incorrect statements about a person resident in India. A person who has resided in India for more than 182 days in the preceding financial year. A person who has gone out of India for taking up employment outside India is considered as a resident. A body corporate registered or incorporated in India is considered as a resident. An office, branch, agency owned or controlled by a person resident is also considered as a resident in India. So you need to tell me which of the following statement is incorrect about the definition of a person resident in India. So, to qualify as a person resident in India, you should be residing for more than 182 days in India for the preceding financial year. Your employment, your place of business should be in India. However, if you leave India and take up employment anywhere outside, or you start a business there, then you will be considered as a non-resident Indian. Yes, so the incorrect statement is B, a person who has gone out of India. All right. Other than the individual, any person or body corporate registered under the Companies Act, any office, branch, agency owned by a person resident, and a resident, any of these, if it is not followed, then they will be considered as a person resident outside India. Okay. Select all the correct statements about the rights of a person resident outside India. The person resident outside India cannot hold foreign currency. The person resident outside India can invest in foreign securities. The person resident outside India can own immovable property outside India. The person resident outside India must repatriate any assets to India. What is the meaning of repatriate? Repatriate means bringing back. So, which of the following are true about the rights of a person resident outside India? So, there is no restriction on holding foreign currency. There's also no restriction on investing in foreign securities. But, however, they will have to return whatever proceeds that are being generated to India. So, repatriation is important. But the statement 4 says that they should repatriate any assets to India. That is not true. All right, so the correct answer will be D, 2 and 3. They can hold foreign currency, they can invest in the foreign securities, they can own immovable property. But if they are acquiring any foreign asset or if they're acquiring any proceeds out of their business in India, that they will have to repatriate. So bringing back to India the realized foreign exchange. If by selling of foreign exchange or holding of the realized amount by selling of an immovable property, that should be repatriated to India, not all the assets. All right. So repatriate to India, bring back the realized assets, realized foreign exchange. All right. So the correct answer is D, 2 and 3 only. 2 and 3 only. Okay. Next. Under Section 4 of the Payment and Settlement Systems Act, which of the following entities are exempt from requiring RBI authorization to operate a payment system? A company receiving payments from its holding or fellow subsidiary company, a microfinance company engaging in recurring payments below 5,000 rupees, a person acting as a duly appointed agent on behalf of another, a system operator granted exemption by RBI in the interest of monetary policy. So, this question we have already covered before also. Which of the following entities are exempt from requiring the RBI authorization? That is, they can run the payment system without obtaining the authorization from RBI. So, which of the following statements are correct? So, one is true. If a company is receiving payments from its holding company, 3 is also true. If they are acting as a duly appointed agent and then they are receiving a payment, and if RBI has specifically exempted some entity from authorization in the interest of monetary policy. So the correct answer will be C, 1, 3, and 4. Another important point, if let's say before the Payment and Settlement System Act it came into force, any payment system was already in existence. They will also have to apply for the authorization within a period not exceeding 6 months from such commencement. Otherwise, they will have to cease their operations. All right. So the correct answer will be 1, 3, and 4. Okay. What is the exemption for seizure under the section 37A? Now, if anyone acquires foreign assets in contravention of the FEMA Act, the central government has the right to seize the value equivalent in India, but there's an exception. If the aggregate value of the foreign assets is more than the prescribed value, if the aggregate value of the foreign assets is less than the prescribed value, if the assets are held only for personal use, if the assets are held temporarily. So, in which of the following situations exemption for seizure will be given? So, like we said, there's no rule that restricts a person from holding foreign assets, right? But there's a prescribed limit for it. No, not if the assets are held temporarily. If the aggregate value of the foreign assets is less than the prescribed value. So this is an exemption. No seizure will be made in case where the aggregate value of such foreign exchange, security or immovable property situated outside of India is less than the value as may be prescribed. So the central government or FEMA under the FEMA Act will prescribe that this is the limit. This is the limit up to which you can acquire foreign exchange, property or asset. If anyone acquires assets beyond that limit, then the seizure of the property will be done, otherwise not. All right. So remember, if the value aggregate value of the foreign assets is less than the prescribed value, then the seizure of the property will not be done. So the correct answer is B. All right. Let us answer this question. Amit, a struggling businessman, mortgages his ancestral home to Zeta Finance Limited under a conditional sale agreement. The contract states that if Amit fails to repay the loan by June 30, 2025, the sale will become absolute. I hope you remember the characteristics of the mortgage by conditional sale. Unfortunately, Amit defaults on the payment and requests additional time, citing unforeseen financial hardships. Meanwhile, Zeta Finance files for foreclosure seeking full ownership. But Amit argues that the transaction is a mortgage and not an actual sale, and the petitions the court to prevent the foreclosure. Now, the court has to decide the legal standing. Considering the situation, why might the financial institutions hesitate to offer loans structured as a conditional sale? So basically, what are the disadvantage of a conditional sale mortgage? The lender is legally required to grant extensions for repayment. The lender cannot enforce repayment beyond the mortgaged property. The borrower retains indefinite redemption rights, making foreclosure impossible. The agreement requires court approval for every mortgage transaction. So, in the mortgage by conditional sale, a sale is made in favor of the creditor, but the sale is ostensible. It is ostensible, which means it is voidable. So, if the customer defaults, then the sale will become absolute. If the customer makes the payment, the sale will become void. In this conditional sale, the creditor they cannot file a suit for selling of the property because it is an ostensible sale. They can only file for foreclosure, that too within 30 years. All right. A, the lender is legally required. No, actually the lender they cannot enforce repayment beyond the mortgaged property. There is there is no personal covenant. No personal covenant. This is the disadvantage of a mortgage by the conditional sale, right? There is no personal covenant for the repayment of the debt, and therefore the bankers they do not prefer this type of mortgage. The mortgagee cannot look to other properties of the mortgager in case this property proves insufficient. Also, the mortgagee they can sue for foreclosure but not for the sale of the property. All right. These are the reasons for which the bankers do not prefer this type of mortgage. Personal covenant means, let's say the property was sold, the amount derived was 50 lakhs, but the loan was of rupees 80 lakhs. The bank will have to bear the loss of 60 lakh, of 30 lakh, right? They cannot file a suit against the borrower and claim the remaining amount. There is no personal covenant. This is the disadvantage. Okay. Which of the following are true regarding the imposition of charges on the electronic payment modes as per the Act? The banks may levy minimal technical service charge for UPI transaction under 1000 rupees. No charges can be levied on the payers or payees using the modes covered under the Income Tax Act. A system provider may impose charges if disclosed in advance through a public notice. Prohibition under Section 10A applies to both direct and indirect modes of charging. So, which of the following are true regarding the application of charges by the payment systems? So, actually, this Rule 11, this is Section 11 of the Payment and Settlement Systems Act. No system provider shall cause any charge in the system that would affect the structure or operation of the payment system. Again, without the prior approval of RBI and by giving notice of 30 days. However, RBI has also said that under Section 10, no bank or payment system shall impose, whether directly or indirectly, any charge upon a person making or receiving a payment using the electronic modes of payment. All right, that is why the electronic modes that we use, they are free of charge. So the correct answer will be 2 and 4. The correct answer will be B. All right. Under 269 SU, this is basically the electronic mode. And 10A, again, direct and indirect modes of charging, there is a prohibition. All right. So the correct answer will be B, 2 and 4 only. All right. Which of the following powers are granted to the RBI under Section 2, 14, and 16? Again, under the Payment and Settlement Systems Act, they require system providers to submit operational returns at RBI prescribed intervals, enter payment system premises and inspect computer systems, access the participant account level customer data, carry out audits and inspections of the payment system operators and participants. So, which of the following powers are given to RBI? RBI has been given the designated authority to regulate and monitor the payment system. They have to apply for authorization to the RBI. RBI can also cancel their authorization at any time. Similarly, RBI has also been given the powers to conduct inspection and scrutiny, right? So, yes, RBI can require the system providers to submit operational returns at the intervals as may be prescribed. They can also enter the payment system premises and inspect the computer system. RBI, by an order in writing, will authorize any officer. They can enter where the payment system is operating. They can ask for any employee for any information or document. They can also carry out audits and inspections of the payment system operators and participants. However, RBI cannot access the participant account level customer data until and unless it is absolutely necessary. The data is to be kept confidential. So the correct answer should be A, B, and D. Yes. Fourth option, A, B, and D. All right. Any officer of RBI duly authorized can enter any premises. They can inspect any equipment, including a computer system or documents. They can ask any person to provide any information. RBI has the power to carry out audit and inspection. All right. So the correct answer will be A, B, and D. Are you guys tired? Why am I not receiving any answers? Try to answer. We have at least 30 questions more. Let us see how many we can do. Okay. Select the incorrect statements about the scope of netting. Netting applies to both payment and delivery obligations among the system participants. Netting does not include claims arising from the dissolution of a system participant. Netting is specified in the rules or regulations of the bylaws. Netting is only applicable for the transactions that are accepted for a settlement at a future date. So, which of the following statements are incorrect? What is netting? Netting determination by the system provider of the amount of money or securities as a result of setting off or adjusting the payment obligations among the system participants. All right, so we are netting the payment, we are setting off the credit and debit, including the claims and obligations arising out of the termination of the system provider or even in insolvency or dissolution, right? And they are also admitted for settlement at a future date, so that only a net claim can be demanded. So the statement A is correct, statement C is also correct, and statement D is also correct. But statement B will be incorrect. No, netting is applicable for the transactions which are admitted for settlement at a future date. All right. Only those transactions will be admitted for settlement that are to be done at a future date. But the statement B says netting does not include claims arising out of dissolution. It does. Let's say the payment system, the system participant is under insolvency or under dissolution. They owe certain amount to the other payment participant, the system participant. It should be set off and then the payment will be done. All right. So the payment obligations of delivery or delivery obligations, including claims and obligations arising out of termination, insolvency or resolution, or any other circumstances given in the bylaws of the transactions which are admitted for settlement at a future date, so that only a net claim can be demanded or a net obligation be owed. All right. So even dissolution and insolvency will attract netting. All right. Under section 30 and 31 of the Act, which of the following are true regarding the penalties for contravention of the default? RBI may impose penalties for the failure to comply with any provisions of the Act. Compounding of the contraventions is permissible only with the prior approval of the central government. Contravention of any RBI issued regulation is punishable. Penalties are also subject to appeal before the RBI appointed appellate boards. So, if the payment system contravenes with any of the provisions or they fail to comply with the directions given by RBI, penalty is imposed. So, RBI may impose penalties for the failure to comply with any provisions. True. However, compounding of contravention is permissible only with prior approval? No. RBI has the authority to impose penalty. So, second statement is incorrect. Also, the penalties are not subject to appeal. So, the correct answer will be 1 and 3 only. 1 and 3 only. So, what the RBI is going to provide, the powers and functions, the time and venue, meeting to be followed, the form and manner in which an application for authorization will be made, the intervals at which the returns are to be given, everything. All the powers have been given to RBI. RBI is the designated authority. All right. The payment system, if their cancellation, the registration is cancelled, then they can make an appeal to the central government. But if a penalty is imposed, that is not subject to appeal. So the correct answer will be C, 1 and 3 only. Okay. Which of the following is a condition that an authorization issued under the subsection 1 of the PSS Act must state? So when the any entity they're applying for a registration authorization under RBI, and RBI gives the registration, gives the authorization. Certain things will have to be mentioned in the authorization certificate, like the date on which the authorization takes place, the conditions subject to which the authorization will be enforced, any fees that is to be paid for the authorization, any other security that is to be furnished for the proper conduct, and it will clearly mention that the payment system can continue to be enforced till the authorization is revoked by RBI. So these are the section 5 where every payment system has to apply for authorization. Section 6, RBI will conduct proper scrutiny and inquiry. And section 7, the application can be accepted or it can be refused. And when RBI is accepting the application, they will give this information that we just discussed. If it is refusing the authorization, then also the reasons in writing should be provided. So, accordingly, the date on which the authorization takes place will be given in the authorization certificate by RBI. All right. So, the correct answer is B. Okay. What happens to a settlement effected under the procedure indicated in the rules for the operation of a payment system? So once a transaction is complete, is it final and irrevocable, or can it be revoked at any time, or does it require further approval from the court, or is it subject to review by the participants? So what is the nature of a transaction through a payment system? What will be the correct answer? So the nature of the transaction that is affected through a payment system, it is final and irrevocable. That means it once completed, it cannot be reversed. Once completed, the transaction cannot be reversed. All right. So any order by the court or through any company, anything, it will not affect the settlement that has become final and irrevocable. All right. So the correct answer is A. Now we come to the next unit. What is defined as a mortgage under the section 58A of the Transfer of Property Act of 1882? Very basic question. You just need to tell what is the definition of a mortgage. Transfer of ownership of property, transfer of interest in specific immovable property, transfer of the movable property, or transfer of the tenancy rights. What is the definition of a mortgage under the Transfer of Property Act? So we know that a mortgage talks about immovable property. It talks about the mortgager and the mortgagee. The person who is transferring the property is the mortgager, and whose interest the transfer is being made is the mortgagee. And it is to secure the money paid or to create a interest thereon. So yes, the correct answer will be B. It is the transfer of interest in specific immovable property. All right. Mortgage money will include the principal and interest. Mortgage deed is the instrument through which the mortgage is created. The contract between the creditor and the debtor. Okay. Which statements are true about the features of a simple mortgage? The mortgagee has no power to sell the property without the intervention of the court. The mortgagee is entitled to payments out of the rents and profits of the mortgaged property. The mortgagee is not put in possession of the property. The registration is mandatory if the principal amount secured is rupees 100 and above. So again, when we were studying this part yesterday in the capsule, I specifically mentioned that the characteristics of each of the mortgage is very important. A simple mortgage or by conditional sale, usufructuary, English mortgage, equitable mortgage. These characteristics are very important. So what should be the correct answer here? The features of a simple mortgage? Right. So what happens in a simple mortgage? The mortgager, without delivering possession to the mortgagee, binds himself personally to pay the mortgage money. And in the event of their failing to pay the money according to the contract, the mortgagee will have the right to cause the mortgage property to be sold, but only through a decree of the court. All right. So, accordingly, the mortgagee has no power to sell the property without the intervention of the court. True. The mortgagee is not entitled to the payments out of the rents and produce. The mortgagee is also not put in possession, and registration is mandatory if the principal amount secured is rupees 100 and above. So the characteristics of a simple mortgage is 1, 3 and 4. This statement B, where the mortgagee is entitled to the payments of the rent and profit, this is the usufructuary mortgage. All right, where the bank will recover the EMIs, interest payment through the rents on the property. So these are the characteristics. Please go through them and remember them. Okay. All right. This case study was there before also, but the question is different. Why is foreclosure rather than an outright sale the only option available to Zeta Finance if Amit defaults? So this is a mortgage by conditional sale. Amit is defaulting, but the companies Zeta Finance, they can only file a suit for foreclosure. Why? Because conditional sale mortgages do not permit the mortgagee to sell the property directly, because Amit can still negotiate a lower repayment amount, because the courts require the mortgagers to sell the property themselves, because the financial institution always prefer foreclosure. Yes, obviously, this is a characteristic of the conditional sale mortgage that the only right available with the mortgagee is the foreclosure. They cannot sue for selling the property. Okay. Under a mortgage by a way of conditional sale, which of the following statements are true? The sale becomes void on the repayment of mortgage money. The mortgagee can look to other properties of the mortgager for repayment. The sale shall become absolute upon the non-payment and a court decree in favor of the mortgagee. The bankers prefer this type of mortgage due to its simplicity. We have already discussed what is a mortgage by conditional sale. Ostensibly, the mortgager sells the property to the mortgagee on the condition that if the payment is made, the sale will become void. They will have to return the property. And if the mortgager defaults, the sale will become absolute. So now foreclosure rights are given to the mortgagee. But there is no personal covenant. Yes. So there is no personal covenant. Second statement becomes incorrect. And the bankers also do not prefer this type of mortgage. So the correct answer will be A, 1 and 3 only. 1 and 3 only. No, 4 is not correct. Bankers, they do not prefer this type of mortgage, right? Because they will not get a personal covenant and they can also not file a suit for the recovery, for the sale. They can only file a suit for foreclosure. So A is correct. 1 and 3 only. All right, next. What happens to the property under an English mortgage if the mortgage money is repaid as agreed? So what happens in the English mortgage? Property is actually sold to the mortgagee. But now the mortgager has repaid the money. So the mortgagee retains the property. The mortgagee transfers the property to a third party. The property is to be reconveyed to the mortgager, or the property is sold at auction. So what will happen in the English mortgage? Yes. Although the property is absolutely sold to the mortgagee, but on the event that the mortgager repays the debt, it has to be reconveyed to the mortgager. So the absolute transfer is subject to a provision that the property shall be reconveyed to the mortgager. All right. This is different from the conditional sale. Why? Because the mortgagee can sue the mortgager for recovery and they can also obtain a decree for sale. That was not there in the conditional sale. Also, in the English mortgage, this is the only type of mortgage in which the decree of court is not required. The only type of mortgage. Okay. Which statements are true about the creation of a mortgage by deposit of title deeds? There must be a debt, there must be a deposit of title deeds, there must be an intention that the deeds shall act as a security, the mortgagee must possess the property. So, the deposit of title deeds, which is also known as equitable mortgage. It is also known as equitable mortgage. The towns in which the equitable mortgage can be created, any town which is specified by the state government, or Kolkata, Chennai, and Mumbai. What happens here? Rather than transferring the property to the mortgagee, I'm going to keep the title deed, the ownership deed. The property can be located anywhere in India, but the mortgage should be created in these particular notified towns. So, yes, A will be correct. 1, 2, and 3. It is not necessary that the mortgagee possess the property. It can be located anywhere in India. Anywhere. Alright, so the correct answer is A. Okay. Which statements are true about the essential features of an anomalous mortgage? It must be a mortgage as defined by Section 58 of the Transfer of Property Act. It is positively defined as one of the listed types of mortgages. It is usually a combination of any two other types of mortgage. It does not involve any transfer of interest in the property. So, what are the characteristics of an anomalous mortgage? So, we have discussed about six types of mortgages. Anomalous mortgage is the last type. The definition which is given in the Transfer of Property Act, a mortgage which is not a simple mortgage, not a mortgage by conditional sale, usufructuary mortgage or English mortgage, or a deposit by title deed. That mortgage is called an anomalous mortgage. So although it is defined in the Transfer of Property Act, but this is a very ambiguous definition. It just means it is a combination of any two of the properly defined mortgages. All right. So it is a mortgage as defined by the Section 58 of the Transfer of Property Act. Correct. It is not positively defined, it is negatively defined. Why negatively? It is not a simple mortgage, not a usufructuary mortgage, not a equitable mortgage. So it is negatively defined. And yes, it is a combination of the two mortgages, but this statement that it does not involve the any transfer of interest, this is not true. So it can be a combination of a simple and usufructuary mortgage, a usufructuary mortgage which is accompanied by a conditional sale also, or any other combination that the mortgager and the mortgagee are agreeing to. So not D, but 1 and 3. B will be the correct answer. All right. It is negatively defined and it is a combination of any of the properly defined mortgages. All right. Okay. According to the Section 47 of the Registration Act of 1908, from when does a registered document operate? From the date of its registration, from the date it is presented in court, from the date of its execution, from the date of its notarization. So, what will be the correct answer? Basically, let's say there are two creditors who have given a loan to the same person. Mr. X has taken loan from ABC Bank, XYZ Bank. Both of them had gotten the charge registered. If one of them had registered, other had not, then it was very obvious that the secured creditor would get priority. But in this case, both the banks have registered the charge. So the priority will be given to the registered document from the time of its execution. Execution means when all the parties have signed and completed the document signifying their agreement to the terms. Right? Registration means when the relevant authority, the ROC or the SARSAI, has recorded the registration. Execution means from when the document becomes legally binding. So, between two registered creditors, between two secured creditors, the mortgage that was executed first will be given priority. Yes, the correct answer is C. Okay, so priority between two registered documents will be given to the one executed earlier. Priority between unregistered and registered will be given to the registered document. All right. What are the popular types of mortgages which are obtained by a banker? Usufructuary, conditional, mortgage by deposit of title deeds, mortgage by deposit of title deeds. Go through the options. Out of these options, only one contains those which are popularly accepted. Others will contain at least one that is usually not favored by the banks. Which ones are not usually favored by the banks? The conditional mortgage is not favored. Usufructuary mortgage, why? Because the only way the bank can recover their amount of loan is through the rent or profit, and it might take a lot of time to recover it. So, yes, the popular ways is correct. Mortgage by the way of deposit of title deeds, simple mortgage, and English. A is correct because usufructuary and conditional is not accepted. Usufructuary is here and conditional is here. All right. So the popular ones are mortgage by the deposit of title deeds, simple mortgage, and English mortgage. All right. Case study. Rohit, a businessman in Chennai, is in urgent need of funds for his textile business. He approaches Delta Bank and offers to mortgage his ancestral property by depositing his title deeds as a security. The bank accepts the deposit and grants the loan under the equitable mortgage. Months later, due to financial difficulties, Rohit struggles with repayment. He decides to relocate his business to Pune and requests Delta Bank to transfer the title deeds to its Pune branch, hoping to restructure the mortgage agreement. The bank, however, refuses, citing legal restrictions. Rohit now disputes the bank's stance and seeks legal clarification. Why did Delta Bank refuse to transfer the deposit of title deeds to Pune? Because Rohit had defaulted, blocking any modifications, because the property mortgages must legally remain with the lending branch, because the equitable mortgage are valid only in the town where the title deeds are deposited, because the mortgaged property was originally located outside Chennai. So, why has this bank rejected the request of Rohit? What will be the correct answer? Yes, the correct answer will be C, right? It will be C. Because the equitable mortgages are only valid in the town where the title deeds are deposited. All right. That is why the bank is going to reject this request. Okay. Which statements are true about the rules of appropriation under the Indian Contract Act of 1872? A creditor can apply any payment received to any debt they choose. The payment must be applied to the specific debt indicated by the debtor. A debtor must always specify the debt for which the payment is being made. The payment can be applied to any debt if no specific debt is indicated. So, what is appropriation? By the same creditor when many debts are owed to the debtor. All right. So, in one instance, any debt of 1 lakh rupees was given, another instance 50,000, another instance 25 lakh debt was given, or 2.5 lakh, whatever. Appropriation means the debtor, when they are making a payment, any payment, they will have to tell the creditor to which debt they should appropriate the payment to, right? If he gives the intimation, the creditor has to act accordingly. If, however, the debtor omits or they fail to give this intimation, then the creditor will have the second right. Then the creditor can appropriate as per their wish. And if neither the creditor nor the debtor appropriates, then it will be as per the law. So the debt that was created first will be discharged first. These are the conditions. So can the creditor apply to any payment? No. The payment must be applied to the specific debt indicated by the debtor. This is true. The debtor must always specify the debt to which it is to be appropriated. Not always. It can be an implied intimation also. And the payment can be applied to any debt if no specific debt is indicated by the debtor. This is the right given to the creditor. So the correct answer becomes 2 and 4. 2 and 4. So there are three sections in our Indian Contract Act that talk about the appropriation. Section 59, where the debtor is giving the intimation. Section 60, where the debtor is not giving the intimation, so the creditor can use their discretion. And Section 61, when neither of them are giving the intimation, so the law will apply and accordingly it will be discharged as per the creation. Okay. Again, a case study is here. Shivam, a trader in Kolkata, needs urgent capital to expand his business. He pledges his stock of imported electronic gadgets to Nova Bank, handing over the warehouse key where the goods are stored. Nova Bank acknowledges the pledge and grants the loan. A few months later, Shivam's financial condition deteriorates and he secretly moves some of the pledged goods to another warehouse to sell them. Nova Bank, upon discovering the movement, claims that the pledge has been invalidated and demands immediate repayment. Shivam argues that he still retains ownership and the goods are not physically delivered, making the pledge unenforceable. The dispute now hinges on whether Nova Bank still holds a valid security interest or not. So basically, the pledge was created, physical possession was not given, goods were stored in the warehouse, and the key to the warehouse was given. Is it a valid pledge or not? So, why is Shivam's argument about physical delivery incorrect? It is a valid pledge because delivery does not always require to be a physical delivery. It can be a constructive delivery as well. So, yes, the correct answer is D because constructive delivery, such as handing over the warehouse key, is legally sufficient to create a valid pledge. All right. Let us answer one or two questions more and then we will end the session. Okay, which of the following is not applicable under the Transfer of Property Act? Which of the following cannot be transferred? Transfer of a marine policy of insurance, transfer of a fire policy of insurance, transfer of a debt or other actionable claims, transfer of rights to sue or initiate proceedings. So, we can assign any actionable claim, any duty, any liability to another person. But we cannot assign what? We cannot transfer a insurance on marine policy. So a transfer of marine policy of insurance is not allowed. So nothing in this section applies to the transfer of a marine or a fire policy. Fire policy is also given, right? Huh, so B will also be true. All right. A and B both should be correct. Last question for today. What does Section 132 of the Transfer of Property Act 1882 state about the rights of an assignee? Assigner assignee relationship. Assigner means the person who is transferring their rights. Assignee means the person to whom the rights are transferred. So the assignee has greater rights than those of the assigner. The assignee has rights equal to those of the assigner. Assignee has less rights or assignee has absolute rights. So, which of the following options correctly determine the rights of the assignee? What will be the correct answer? So, the assigner cannot transfer any liability, any duty in excess to what they originally hold. So, the assignee is going to have the rights equal to those of the assigner. The assignee can only have the rights equal to the assigner. They cannot have better rights. All right, they will have equal rights. So, from module B, we have around 20-25 questions more, but because we do not have time to cover them, I will upload the complete PDF. You will have access to other questions also. Download the PDF, practice these questions. All right, along with the questions, the correct answers and explanations are also there, so that won't be a problem. So that is all for today. I will be ending the session now. Let me see how many questions are here. Okay, quite a few questions are here. So all of these questions, you can download the PDF and you can practice these questions on your own. All right. So from 9 p.m. we have our capsule batch and we need to start the module C today. So I will meet you after 5 minutes on the Oliveboard platform where we will start the module C. If you haven't yet joined the capsule batch, enroll now and I will see you in the class. So thank you so much for attending the session. Like the video, share the video, subscribe to the channel because all of these sessions are very important, and comment down below if you have any other queries. So thank you so much for attending. Take care and all the best.